Hey, John, very good to see you as always. Today we're doing a 2022 market outlook. As we know, this year is going to be about the turnaround, right? Following the stimulus and rally of 2020 and 2021, the purpose of the market outlook is not to predict, but to prepare. And you know this already, but CIO at Brookstone Capital Management, Mark DiOrio, has said already that we should expect volatility and a correction, perhaps even an echo bear market, which means a correction of 20% or more. So, what are your thoughts on this in 2022?
Yeah, I have the same concerns
Yeah.
that Mark DiOrio has. As a matter of fact, Tom and I had Mark on our Retire Happy podcast last week. And as I've mentioned in the past, I think we're really in a perfect storm of events. Number one, we're at record market highs with the stock market. And I know we've heard this term a couple times over the years, but record highs is not always a good thing, for the future, that is. Number two, we're at extremely high inflation. Inflation
Right.
exceeded 7% last year.
Right.
So inflation is an issue. Number three, we have monetary policy, which is really going to potentially add to a lot of volatility this year. And last, and kind of little less known underlying is we had a huge amount of global public offerings on the market last year. So
Right.
that means we had too many stocks on the stock market, which is a place of supply and demand.
Well, so you touched about this for a second, the monetary policy with the Fed saying basically that he's going to be raising interest rates possibly three times this year. Monetary policy is a key driver of asset prices so that inflation doesn't run away, right? So can you just explain what's going on here?
Yeah, so I think we have two monetary policies going on. Number one, and we talked about this a lot last year on NBC and in our other videos, is the Fed had a huge amount of what we call velocity of M2, or the printing of money,
Right.
the highest we've seen since World War II. That was a driver of inflation. Now, going into this year, we're seeing Fed tightening that M2 supply. So liquidity is not as high. So that's the first Fed policy. And then the second Fed policy, the better known policy, is the Fed is hinting at raising interest rates. And, especially for retirees that have a lot of bonds, um, depending on how aggressive the Fed gets in this approach to raising interest rates, could lead to more volatility that we've seen, and could stunt growth.
Right. So you and I have talked about it, and the purpose of today's video is to help everybody prepare. So how do I address these risks?
Yeah, well, what we're doing at Brookstone is, for the last couple of weeks, we've had some very advanced conversations with our
Mhm.
analysts, trying to reallocate some of our clients' policies to not only address the future potential market risk and volatility, but to address the bond risk at hand. So we're looking at a lot of advanced investments like structured notes, hedged equity,
Right.
and even some new buffered investments that could still give an opportunistic return, but are more defensive towards any market volatility.
Okay. And one other thing that I wanted to bring up with you, John, because I know that you are a big student of behavioral finance. You've studied data from 30 years, which tells us that during market downturns, people tend to panic and sell. So, in this chart here, where do you think we are?
Well, I do love behavioral finance, and
Yep.
Dalbar has discussed investor irrationality.
Hmm.
And when we look back, that we've heard the term market highs for the last couple years, and we're in a long bull run here. So a lot of people believe that we're at the top of this chart,
Right.
which is near euphoria. And market highs are a marketing term. that lead to a lot of euphoria and trying to keep up with the Joneses. So, going forward, if there is that volatility, and not only does Brookstone feel that there could be a sharp 20% decline, but so does JP Morgan and
Mhm.
Vanguard. So we have to understand that if this happens, that the normal behavioral finance spectrum of fear and greed, that we're going to go more towards the fear side, and people, especially early in retirement, that don't have a proper plan for this, will panic and sell. So what I've told my clients, and we saw this with the COVID crash, is that the best days often follow the worst days.
Right.
And the investor and the advisor who plans for their clients to, at some point in time, approach this market correction, if those investors stay the course of their plan, they have been rewarded over the course of history. And we have to remember that, a true retirement plan is not a 1, 3, or 5 year portfolio. Your retirement portfolio should be over 20 to 30 years to solve your concerns, match your goals, and make sure you don't run out of money.
Right. Well, it was a lot of fun to talk to you about this, and I know I could talk about it all day with you. If somebody that would like some help with if their portfolio is ready to, withstand the changes that are coming with 2022, what's the best way to reach you?
Yeah, you have two ways. Give us a call at the office, 858-935-6210, or visit our website, www.gosecurus.com. And from either location, you can either schedule a 15-minute phone call or a 90-minute strategy session with us.
That's great. John, thank you.
Thank you, Erin.